So Jupiter, for those unfamiliar, is the largest listed pure-play manganese mining company in the world by virtue of the fact that we're the major investor in one of the world's best manganese mines. It's a mine called Chippy in South Africa. I'll show you a little bit more on the mine in a moment. But that mine is inarguably one of the best mines by profitability, mine life, and also scale. So as a consequence of being exposed to that fantastic asset, which has been operating since 2012, Jupiter's been listed in its share in that mine since 2018. We have been able to pay a fantastic dividend to our shareholders. You can see there on the page, we've paid an average yield of 12% in the last 5.5 years, or put another way, 83% of our current market cap has been paid in dividends to our shareholders in the last 5.5 years, notwithstanding the mine that has supported those dividends has 120 years of mine life remaining. So that's the business we have today. As I said, it is an important manganese mine in the world, located in the world's most prominent manganese mining district, and I'll show you a bit more about that in a moment. There's no debt at either the mine level or at Jupiter, and so that means Jupiter has pure exposure to the manganese market and the manganese price, and there's value for investors through that exposure in a couple of ways. Manganese is irreplaceable in the making of steel, and it also increasingly will be utilised in the making of electric vehicle batteries. So the demand side for steel is slow and steady, but necessary. From batteries, tiny today but growing fast. The supply side of manganese, as I'll show you in a moment, is quite interesting as well. It's very concentrated around 5 major mines. Our mine is one of those. Those 5 major mines make up 44% of the world's manganese supply. And so that means if there is any disruption to the operation of one of those major mines, it tends to go to the manganese price. And there's a disruption like that ongoing at the moment, and I'll tell you more about that in a second. Longer term, on the supply side of manganese, there will be contraction. There will be some of those mines coming to end of mine life, mines that have been prominent in supplying the world with manganese for the last 50 or 60 years, coming to end of mine life in the next 10 years or so. The mine that we're exposed to has 120 years of mine life remaining. There are a few others in South Africa that have a very long mine life remaining as well. And so we have a strategy at Jupiter to continue what we've been doing, which is providing good exposure to the manganese price, providing outstanding dividends under a continuing policy. But the strategy that we announced last year, in addition to that, is to grow, to take advantage of that manganese thematic looking out that I've mentioned a moment ago, that we are very well positioned for. And so that's the strategy today. Briefly on Chippy, here's a few KPIs just on the mine itself. You can see top left-hand corner there, all of these data points back to the time of Jupiter's IPO 5.5 years ago. Chippy sales, 3.4 million tonnes per annum on average for that period of time. The year that we've just completed will actually be slightly above that, 3.55. Costs have been very competitive. That level there places Chippy, as I mentioned, as one of the more profitable manganese mines in the world, and that is a firm focus of our strategy, to remain at the lower end of costs of the Kalahari manganese field, because as you can see on the chart there, that means that through the cycle, notwithstanding manganese prices will naturally go up and down based on different factors, Chippy has been profitable and cash generative. Again, no debt at the mine or at Jupiter, and so that's enabled the dividend yield that I've mentioned before. Bottom left-hand corner, you can see Chippy's mine life. As I mentioned, 121 years of mine life remaining at current production run rates. Very significant endowment in the ground. The other mines that I've shown you there are also South African Kalahari manganese field mines. This is an area 32 kilometres north to south that has all of these fantastic mines in there. And that's quite distinct from the rest of the world, where you have, as I mentioned before, here in Australia, in Brazil, in China, 3 major manganese producing geographies, with their mines coming to end of mine life in the next 10 or so years. And so that's really going to present an opportunity for the South African mines to increase production and take up more market share, and that's why that's part of our growth strategy. On the bottom right-hand corner, you can just see manganese price is the line there. I've charted in dotted line where the manganese price is today. and where the earnings of the mine have been through that cycle. So you can see, even at low points in the manganese price cycle, this is a mine that's produced positive earnings. That's a very busy photo of the Kalahari manganese field. Chippy is at the southern end, boxed out in orange there, as you can see. But the point is just that, as I've said, this is an area of incredible endowment. You have 73% of the world's manganese reserves in that photo there, 32 kilometres north to south. A number of these mines are cheek by jowl with each other. Our mine is immediately co-adjacent with Mamatwan, owned by South32, Anglo and others. There's another mine, UMK, just to the immediate north of us. All three of those mines, Chippy, Mamatwan, UMK, share the same geology. All three of them are top 10 producing manganese mines. UMK has 140 years of mine life remaining and Chippy has 120 years of mine life remaining. So obviously there's an opportunity to consolidate, to take greater ownership against that outlook for the manganese market that I've mentioned, but also because on our doorstep here we have a number of the world's best manganese mines and we're already invested in one of them. Just briefly on Jupiter's dividend payment track record. So the financials on the page here are based on Jupiter's 49.9% ownership of Chippy, and you can see at the bottom of the page there the dividend yield for each of those financial years back to the time of Jupiter's listing. 12% average yield as against an ASX 200 average of 5% over that same period, and again 83% of our current market cap paid in dividends over that period of time. Unsurprisingly, given what I've just said, we're only focused on manganese, we have no debt, and we've got a mine there that's one of the best in the world. Jupiter's share price is very correlated with the manganese price. You can see on the page here Jupiter's share price in blue and the manganese price in gold. Strong correlation there, some volatility. There's opportunity in that volatility, obviously, from an investment perspective. I've boxed out there on that chart what has happened to both the manganese price and the Jupiter share price since the Gemco mine in the Northern Territory was hit by a cyclone in March. That's caused, as you can see, fairly extreme volatility in both the manganese price and the Jupiter share price. The manganese price ran up very strongly in May, June. It's since retraced to about average levels, but that disruption has at least another 5 months remaining. And so when I come to the makeup of the supply side now, you can see the point that I'm making around the opportunities for disruption through the cycle because manganese supply is so concentrated. Shown graphically here on this page are the 62 manganese mines in the world that are in the CRU database. The top 5 mines by production make up together 44% of the world's manganese production. The mine that I just mentioned that is out of action at the moment due to cyclone impacts, Gemco, makes up 12% of the world's manganese production. Our mine makes up 6%. To the extent that historically there's been even short-term disruptions to supply from one of these major mines, because the world relies so heavily, given how concentrated that supply side is, it tends to go to manganese price. So it was unsurprising that we're seeing volatility due to the protracted outage of Gemco that's ongoing at the moment. That cyclone, unsurprisingly, and the disruption to Gemco's supply has caused stockpiles in China. China is the major geographic market for manganese to have been drawn down to 3+ year low levels. You can see there since March the impact. Those yellow bars are the stockpile levels in China. The blue line again is the manganese price. So it appears on the basis of that there is a bit of a dislocation between low stockpile levels and manganese prices that have actually come off recently. Again, this is a market adjusting to disruption that it hasn't seen before, and so volatility through that period of time, but also weak Chinese demand prevailing at the moment is the story of what's going on there at the moment. But so is the supply side disruption, and that has some time left to run. Longer term, you can see here, very long term, out to 2050, what I was saying earlier. The manganese supply side is quite interesting, we think, and that is because you're going to have some major manganese mines in the world coming to end of mine life in the next 10 years or so, but also a theme of grade runoff. We're invested in a mine, and there are a few others around us in South Africa that are on the other end of the spectrum. good grade, lots of mine life remaining. And so that's why when we come to our growth strategy, we see that outlook as quite attractive. The demand for manganese, it's mostly used today in the making of steel, and that will continue. You can't make manganese without steel. It's what gives steel its strength, and that's why it's irreplaceable and has been listed by the US as a critical mineral well before batteries came along, because you can't make bridges or anything you want in terms of infrastructure, for example, without the use of manganese. So there's a robust demand case for manganese looking forward. There's new demand coming from electric vehicle batteries, and that will present margin opportunities. The volumes, although they'll be growing fast, won't actually come close to outstripping the volume of demand from steel. But again, the supply side and the fact that we're exposed to a long life mine and have others around us where the rest of the world is on a shrinking thematic, provides that supply gap that starts to emerge in 2030. That supply gap, we think, will be closed by South African mines that have the ability to expand production when there's an opportunity valuably to do so, and Chippy's a prime example of that. So that backdrop that I've just given you sets the tone for our 5-year strategy that you can see here on the page. We're 1 year into this strategy and busy on all elements that you can see there. There is what we call fittest in the field, meaning we want to continue to be the most cost-efficient mine in the Kalahari manganese field. We are today. A big part of continuing that success is through bulk logistics. Logistics make up 35% of Chippy's cost of production. Mining makes up 10%. That's a function of how far these mines are from port, but also because South African logistics, particularly rail, are constrained and inefficient by global standards. And so that's why, as part of that limb, we're particularly focused in that area. I've touched a few times on why I think there's an opportunity to position for growth, both organically. Chippy is an open cast mine. It's been running at 3.4 million tonnes per annum. It has crushing capacity of 4 million tonnes per annum with 120 years of mine life around it, and a outlook in the rest of the world where supply elsewhere in the world is contracting. And so lifting Chippy's production to the right level of production sustainably at the right time in the market is part of the strategy there, and also growing our exposure through M&A to Kalahari manganese field production. We have an ESG limb, and we brought out our inaugural sustainability report this year. That's really communicating the good work that's already going on there. The centrepiece strategy in the short term as part of that limb of our strategy is putting solar in at the mine. That's for a couple of reasons. Kalahari is a very sunny part of the world, but also because South African power is intermittent. We have our own power station, so we're not worried about that from a supply point of view, but it'll be cheaper from a financial perspective and better from an ESG perspective to put solar in instead of using our own diesel. And the final limb is about taking waste, low grade, what we call low grade, 30 to 32% manganese ore, and directing that into its highest value in use, which is in batteries. Not large volumes. We'll be able to take material already mined off the stockpile, costed as waste, and direct it into that particular usage. And so we have a study underway in that part of our strategy at the moment. So in summary, the business today, Jupiter, has a really successful track record because of our investment in Chippy and because that's a fantastic asset that is well run. And that's enabled us to pay the strong dividend yield that I've just demonstrated to you, and we're looking to continue that same dividend policy moving forward. We have announced, it's on our website, a growth strategy to grow around that existing proposition in the areas that I've just shown you. And finally, because we only are focused on manganese, because it's a long life, well-run asset, we're the largest listed manganese miner in the world, and we're therefore exposed to manganese price upside, which can be interesting through the cycle, and there's that going on now because of the supply disruption to that major mine I showed you a moment ago. Thank you very much for your time. Any time for questions, Toby?
Thanks, Brad. Very compelling investment proposition there at Jupiter Mines. We may have time for one question.
Okay.
You touched upon it briefly, the implementation of EV batteries comprising manganese. Could you please outline that a bit further, and when do you see that having a meaningful impact on the business?
Yeah, thanks for the question. So the value of manganese in the cathode of electric vehicle batteries is that manganese can bring energy density more cheaply and more stably than other cathode materials. And so that's why you can see really amongst any of the various cathode chemistries, and frankly, regardless of battery type, Chinese battery types LFP are moving to LFMP, non-Chinese, more expensive battery types are looking to use more manganese. The Chinese battery types, because manganese can introduce more energy density, therefore range capability, in a cost-efficient manner. NMC batteries and other variants of that non-Chinese battery types are expensive, high-performing. Manganese can bring down the cost of those battery types, mainly by substituting in for cobalt. But manganese also brings the same capabilities to solid-state batteries, sodium-ion batteries, and so it has use across the spectrum. The use of manganese into batteries at the moment is tiny, and that's because most of the battery makers are looking to obviously increase their production, but also move their chemistries towards greater manganese use. So we're looking at a supply deficit that starts to emerge in the latter part of this decade, 2028, and that's the timing that we're looking to target, to take what I mentioned, Chippy low-grade ore, and beneficiate it through an infrastructure project to be producing in that period of time. Jupiter has some natural advantages going for it that we think position us well competitively in that regard. We've just published a scoping study. It's on our website for anyone who is interested, and we're currently in a pre-feasibility study. So we'll be working through those phases of work, ultimately looking to produce material in 2028.